Sound check. Sure. Good evening, students. So today we are going to start with our next lecture on your derivatives. In the last lecture, that is yesterday, we completed the entire futures part, and today we are going to start with options. Okay. So are you all ready? Okay. And we'll be starting with your options part. So without wasting any further time of yours, let us start with the most important part, that is your options. Okay. Okay, my dear students. Now, as we have understood till now, derivatives is nothing but a financial contract, and the price of the financial contract is based on some underlying asset. So your underlying asset can be either your commodities, your stock, or your stock index. Okay, that is something which we discovered yesterday. Now, my dear students, we are going to learn how do you consider your options, how to value a particular option, then what should be the entire strategy with regards to your riskless model or your risk neutral model, what is put call parity. Also, at the same time, we'll be discussing how are we going to price a particular option, and then what is your ITM, ATM, OTM. So everything regarding options we are going to learn today. Okay. So, my dear students, let us start with the basics. What type of a derivative contract an option is? So, option is nothing but a financial contract where it gives a right to a particular holder to execute the contract or not. Okay. So, let us put it like this. Let's say, for example, just one second. Okay. So, let's say, for example, uh, I want to buy Reliance Industries Limited shares. Okay, I want to buy Reliance Industries Limited shares. Okay, at the end of year one. So I want to buy RIL at the end of year one. And right now, the current market price, which is the spot price, is, let's say, for example, rupees 1500. So now, my dear students, I am of the opinion that, okay, the existing market price per share is rupees 1500. Okay, the current market price is rupees 1500. And I think that at the end of year one, the share price of Reliance Industries Limited is going to be, example, rupees 2000. Okay. So I am going to have a very bullish view about this particular stock. So in that case, what can I do? I have an option. to enter into a particular contract where I will have a right to buy. I will have a right to buy Reliance Industries Limited shares after the end of year one at a certain exercise price. Now, this certain exercise price is actually called as your strike price. Now, let's say, for example, your strike price is rupees 1500. So in this particular case, what's the spot price which is going on? 1500. What's the strike price which is going on? 1500. So I can enter into a financial contract which gives me a right to buy Reliance Industries Limited at rupees 1500 at the end of year one, irrespective of whatever is the market price at the end of year one. Suppose at the end of year one, even if suppose the market price of Reliance Industries Limited is 4000, but still, can I buy this Reliance Industries Limited shares at rupees 1500? Come on, yes or no? Yes, sir. So it is absolutely clear that whenever we are bullish about a particular stock, so in that particular case, we can enter into a financial contract which gives us a right to buy that particular asset, that particular asset at a strike price which is pre-decided at the end of expiry. So in this particular case, let's say for example, the market price of RIL is at the end of year one amounting to 2500. Then don't you think, my dear students, I will definitely execute the right? So what will happen in case of execution of right? I will go to my option seller and I will tell them, let me now execute this right, and I am going to buy the shares from you at rupees 1500. So my dear students, what is actually the market price? The market price at the end of year one is 2500. I will definitely execute this right because there is a contract which gives me a right to buy the particular asset at 1500 rupees. So does it make sense to execute the contract? Come on, yes or no? Yes, sir. But what if at the end of year one, suppose the market price of Reliance Industries Limited is 500 rupees. Now I have a financial contract which gives me a right to buy the share of RIL at 1500 rupees. But at the time of expiry, let's say for example, the market price is 500 rupees. So I can get Reliance Industries Limited shares from the market itself at 500 rupees. Now, when I get Reliance Industries Limited shares from the market at 500 rupees, then should I go and execute this particular option contract? Then the answer is absolutely no. So that is why you will always understand that option contracts always gives you a right but not an obligation to perform the same. And this is only and only applicable to whom? These are applicable to these are applicable to whom? These are applicable to the one who wants to buy the particular asset. So basically for an option holder. So an option holder will have a right but not an obligation to execute the contract. An option holder will only and only execute the contract if, can I say, it is in favor of the option holder. Come on, yes or no? Yes, sir. Now you must be thinking that who will enter into a such kind of a contract where it is on the discretion of the option holder whether to buy the particular asset or not, or whether to execute the option contract or not. So in this particular case, the option buyer is actually required to pay some premium to the option seller. So if suppose today's price is 1500 rupees, and if suppose the strike price is also 1500 rupees, so I will now pay some premium. Let's say for example, my premium is example 100 rupees. So I will pay a premium of 100 rupees. I will pay a premium of 100 rupees. And by making the payment of premium of 100 rupees, I will guarantee this, that the opposite party is going to compulsory oblige this particular contract if I want to execute it. So whenever we are dealing with an option contract, there are two parties to it. The first party is called as an option buyer. The second party is called as an option seller. Whenever we are talking about option buyer, also known as an option holder, can I say that option holder will always have a right but not an obligation to execute the contract? And option seller, which is also known as option writer, can I say they have to compulsory perform the duties of the contract if option buyer wants to execute it? Come on, yes or no? Yes, sir. And for this, option buyer will always give some premium to the option seller. Okay. So coming back to our example, let's say for example, the spot price of Reliance Industries Limited is 1500 rupees and I want to buy RIL at the end of year one for 1500 rupees, for which I require to pay a premium of 100 rupees. Now, in this particular case, let's say, for example, at the end of year one, the market price becomes, example, 2000 rupees. Now, what do you think an option holder will do? Will he execute the contract? Come on, yes or no? Then the answer is yes. So he will go to the option seller and tell, okay, listen, now I want to buy the shares from you. Okay, and you had committed that you will provide me with the shares for 1500 rupees. So definitely the option buyer will be at a profit. Is it in favor of the option holder? Come on, yes or no? Of course, yes. On the contrary, my dear students, if price becomes rupees 500, then in that particular case, he will not execute this contract. And once he will not execute the contract, whatever is the premium paid, can I say anyway, that will be your amount forfeited and the option writer is going to get this amount of the premium as the receipt. Come on, yes or no? Then the answer is yes, sir. Okay. So my dear students, always remember like this, that option contracts gives you a right, but not an obligation to perform a particular contract. Now, let's say for example, this was pertaining to your call options. So these are called as your call options, which gives the option holder a right to buy. Now there is something which is also called as your put options. Now put options are exactly opposite. It gives right to sell for the person who is holding the option contract. Now, same situation. Suppose the spot price of Reliance Industries Limited is 1500 rupees. And let's say the strike price is, example, 1500. Okay. Now, I fear that at the end of year one, suppose RIL will fall to rupees 500. Now, in this particular case, if I think that Reliance Industries Limited is going to fall to rupees 500, it means that the prices are going to come down. Now, in this particular situation, when the prices are going to come down, what will happen is I will have a right to sell Reliance Industries Limited shares for 1500 rupees, even if the price becomes 50, 500 or whatever. But yes, if suppose the market price after the end of year one becomes 2000 rupees, then do you think that I will execute this particular option contract? Then the answer is absolutely no. Why? Because it is not in the favor of the option holder. So as I can have a bullish view about a stock, it is very much possible that I can have a bearish view of a particular stock as well. So when I'm going to have a bearish view of a particular stock, then in this particular case, what is going to be the consequence of this is that I will first enter into an agreement where the spot price is, let's say, 1500. I will enter into a contract for the right to sell Reliance Industries Limited at rupees 1500, for which I will pay some premium. I will pay some premium to the person who is writing the option contract, that is to the opposite party. So in this particular case, let's say for example, the premium paid is 100 rupees. Now, my dear students, I have paid a premium of 100 rupees, which gives me a right to sell Reliance for 1500 rupees at the end of year one. Now, at the end of year one, suppose the market price of RIL examples becomes 2000 rupees. Now, do you think the option holder will sell this Reliance Industries Limited as per the contract? Then the answer is absolutely no. What will the option buyer do? It will sell Reliance in the open market if it wants. So in this particular case, my dear students, if the price of Reliance falls to 200 rupees at the end of year one, okay, in this case, can I say that the option buyer has a right to execute, the option seller has a right to execute the contract? Come on, yes or no? Then the answer is yes. And the option buyer is going to execute this right to sell, because the option buyer always pays the premium to it. So what I'm trying to make you understand is that there are two possible option contracts. The first one, we call it as call option, and the second one we call it as put option. Now, call option gives you a right to buy, but not an obligation. Put option gives you a right to sell, but not an obligation. Now, whenever I'm dealing with a call option, it gives me right to buy, whether I want to buy this particular asset or not. So there are two parties to it. So there will be an option holder, and this option holder is also called as an option buyer, and there will be an option seller, and this is known as an option writer. Similarly, my dear students, when I want to sell this particular asset, so I'm worried about the fall in the price in future. So I can enter into an option buying contract or an option holder, which gives me a right to sell, but it is not an obligation. And there will be a person who is an option seller or option writer. Now, my dear students, here definitely we can say that they pay premium, right? So here also option holder is going to pay premium. Yes or no? Then the answer is yes, sir. Okay, so option holder will always pay option seller some amount of the premium as well. Okay, so basically whenever I'm dealing with options, okay, there are two possible options available: call option and put option. So basically, a person who buys a call option, what is the view of the option buyer? Can I say the view is market is going to be bullish? Okay, that's why he buys the call option, because he knows that after some period of time the price is going to go up. So he will definitely buy a call option. Also at the same time, who will buy a put option? The person who has a bearish view. Okay, so if I think that the spot of RIL is, let's say for example, 1500, okay, and the strike price is 1500, I think that the price is going to become 2000. So in that particular case I will buy a call option. But there is an opposite party who always thinks the opposite, and the opposite party will think, no yaar, Reliance will not go to 2000, Reliance will fall to 1200 rupees. Now when Reliance is going to fall to 1200 rupees, this person will not come to execute the transaction only, so entire premium received is mine. So that is what an option writer will think. Okay, so an option writer, a person who writes a call option, will always have a bearish view, okay. Similarly, there is someone who will tell, okay, fine, I want to sell this asset at 1500 rupees after the end of year one. So I think that after the end of year one, the price might become 500 rupees also. So am I going to have a bearish view for the same common? Yes or no? Yes, I might have a bearish view. But still there is an opposite person who can have a different view as well, who can have a bullish view. So let's say for example my price is 1500, okay, and I think that, after some period of time it might fall to 500 rupees, so let me buy a put option. But there is someone else who might think that, okay, at the end of year one the price is going to be 2000, so this contract no one will come to execute it, so he will definitely be entering into option selling or option writing. So now I'm giving you basically two options for every view. If you are having a bullish view, then either you can buy a call option or you can sell a put option, right? You can either buy a call option or you can sell a put option, okay? Because both of them are going to have a bullish view, right? So if you have a bullish view, then you have two options. Number one, you can buy a call option, and number two, you can sell put option. And my dear students, if suppose you are going to have a bearish view, then you will have two options, that is buy put option, and on the contrary there will be sell call option. Okay, so here you are an option buyer, here you are an option seller. The beauty of option contracts is that for an option buyer, the loss is always limited. The loss is limited to the extent of the premium which is being paid. Okay. So at the time of expiry, whatever I decide, suppose that doesn't work, so what is going to be my loss restricted to? So my loss will be restricted to, finally, how much premium am I going to pay? That's it. How much premium am I going to pay? Okay, so let's say for example, let me put it like this. This is 0 to 12 months. Okay, suppose the strike price is 1500, the spot is also 1500. I think that the market price is going to be rupees 2000. Okay, the market price is going to be rupees 2000. It's a very simple concept. The market price is going to be rupees 2000. So what will I do? I will buy a call option by paying a premium of 100 rupees. Acha, if it goes to 2000, then very good. Okay, I will definitely execute this contract, right? But if suppose, because I have a right to buy it at 1500, the market price is 2000. So it is in favor of the particular option buyer. So he will definitely go for it. But my dear students, what if the price becomes 500? Now, do you think that I will execute the contract? No. So I will not execute the contract. So can I say that my loss is just restricted to this 100 rupees? Okay, so for an option holder, the loss is always limited. For an option buyer, the loss is limited. Similarly, for an option buyer here also, for put option, the loss is going to be limited. And here for an option writer, there will be unlimited loss. And here also there will be unlimited loss, because you never know what the price is going to be. So an option seller always faces unlimited loss, which an option buyer is not going to face. So whatever the price is, suppose the price becomes 20,000, but still the option seller has to execute this contract. Okay, because if the option holder will come, because he has paid the premium for it, so an option seller has to compulsory execute this. So it is irrespective of the fact whether the option buyer is going to if it is going to be 20,000, 25,000, or whatever the price is going to be, the option seller has to compulsory execute this transaction. So that is why they always face unlimited loss. But you will see in practical life, and you must have heard this also, in capital markets, in derivative markets, you will always see that option writers are actually the one who are going to, option writers are actually the one who are going to, definitely make money, because these views, of people that the price will go up and the price will go down, etc., that usually does not materialize. So that is why it's always the option writers who are going to earn by receiving the premium part. Okay, so this is usually what practically happens. Okay, so basically, I've explained you option contracts, call option, put option, right to buy, right to sell, which parties are there, what are the views possible, what is the liability of the option holder, option writer, all these things we have discussed. Now, my dear students, let us study something which is called as moneyness of option contract. Now, what is moneyness of the option contract? So basically, my dear students, there are actually three types of the possibilities regarding a particular option contract, which can be in the money, out of the money, and at the money. Okay, so there are three types: in the money, out of the money, and at the money. Now, my dear students, when I'm talking about in the money call option, okay, let's say for example, I'm talking about in the money. Now, what is in the money? Let's say for example, the strike price is 1500 rupees. So basically, I have a right to buy Reliance Industries Limited for 1500 rupees. Okay, let's say for example, on expiry, the price becomes, on expiry, the price becomes, let's say, 2000 rupees. Can I say that I have a right to buy at 1500, and when the price becomes 2000 on expiry, this contract will be called as in the money? Why? Because already I have a right to buy it at 1500 rupees. Okay. And the market price is 2000 rupees. So basically, this particular contract is going to be in favor of the option buyer. So for an option buyer of a call option, so when I'm talking about call option, okay, and for a call option, there is an option buyer. Okay, so you always have to understand that for an option buyer, your strike price, if it is less than the spot on expiry, if it is less than the spot on expiry. Okay, so suppose this is 1500 rupees and the spot on expiry is 2000 rupees. Okay, if this is 1500 and the spot on expiry is 2000 rupees. Now, can I say the option holder will definitely execute this particular contract? So this will be called as in the money. What is out of the money call option? So for out of the money, suppose your strike price is 1500 and suppose your spot is, let's say for example, 500 rupees. Now it is against the option holder to execute the contract. And now when something is against the option holder to execute this particular contract, we say this is out of the money. And what is at the money? When the strike price is equal to your spot. So basically your strike price is 1500 and your spot is 1500. So now in this particular case, can I say this is at the money option? Okay. So basically, whenever we compare strike price with whatever is the spot, we can get whether there is in the money, out of the money, or at the money options. Similarly, my dear students, for a put option also, for a put option also, this can be a situation where suppose the strike price will be 1500. Okay, suppose the strike price is 1500, and let's say for example the spot on expiry. Suppose my spot on expiry is example is, let's say for example 500 rupees. Now for a put option, I have a contract which allows me to sell this particular shares for 1500 rupees, and the spot which is going on, that is 500 rupees. So can I say that I have a right to sell it at 1500 when the spot is 500? Is it in favor of the option buyer? Come on, yes or no? Then the answer is absolutely yes. So when it is in favor of the option holder to execute the contract, we say it's in the money. Similarly here, let's say for example, if this is 1500, but in the market, we can sell it at 2000 rupees, then we say this is out of the money. And my dear students, when both of them are equal, we say at the money. I hope my dear students, you all are understanding something with regards to moneyness of the option. So the first thing I taught you was what are option contracts? It is a right but not the obligation. What are the views which are possible? Who's the option buyer, who's the option writer. We have revised regarding the liability part as well. Then we discussed the moneyness part, that is ITM, OTM and ATM for call option as well as for your put option. Okay, so for your put option, my dear students, when the exercise price is greater than spot, we will say it is in the money. When the exercise price is less than the spot, we will say out of the money. And whenever your exercise price is equal to spot, so this will be called as at the money. Okay, now continuing further, my dear students, what is the value of the option? Okay, so basically, my dear students, let us decode this premium part. Okay, so whatever is this premium which is being paid by the option buyer to the option seller. Okay, so there are techniques on the basis of which this premium has been paid. Okay, now how are we going to calculate this amount of the premium first of all? Okay, so let us understand this. That premium, my dear students, premium is nothing but the combination of two important things. That is your intrinsic value and your time value. So intrinsic value plus time value put together will give you the premium component. Come on, yes or no? Yes, sir. Okay, so intrinsic value and time value combined is going to give you your premium part. Okay, so let us understand something like this. Okay, let's say for example, okay, the spot is, let's say, 100 rupees. Okay, and right now I want to buy a call option for 100 rupees. Okay, so it is definitely at the money call option. Okay, on the expiry, let's say for example, this spot becomes 150 rupees. Now, on the expiry of the contract, when the spot becomes 150 rupees, I have a right to buy, because this is the call option. I have a right to buy this particular stock for 100 rupees when the price in the market is 150 rupees. Can I say it's the in the money call option? Come on, yes or no? Yes. Does this particular option contract have some value? Yes or no? Yes. What is the value? The value is nothing but 50 rupees. So can I say your intrinsic value will be 50 rupees? Now there is no time value left. Why there is no time value left? Because we are right now standing on the expiry part. So now there is no further chance that the stock price can be something else. So there is no time value attached to it. So that is why the premium will be 50 on the day of the expiry. So that is called as the value of the call option at expiry. Okay. So once again, I'm repeating, my dear students. Let's say, for example, today is 1st of April. Okay. And on 1st of April, let's say, for example, I am entering into a call option, okay, whose expiry is, let's say, 30th of June. So it's a 3-month contract, okay. And suppose right now the spot price is 100 rupees, okay. And let's say, for example, I am entering into a contract, where I have a right to buy this share for 100 rupees. So can I say presently this is at the money, beta? Right? This is at the money. So this is an at the money contract. Now this is going to expire on 30th of June. Okay. Now immediately there will be some premium which I have to pay to the option seller. Okay. Why do I have to pay the premium? Because now there are 3 months which are left for the option contract to expire. So what I will say, okay, listen, I am ready to pay, let's say, a premium of 20 rupees. Okay. Now, can I say the value of the call option is the combination of intrinsic value plus time value? So my intrinsic value, what is the intrinsic value? Okay, the difference between whatever is the spot and the strike price. So my strike price is also 100. It means I have a right to buy it at 100. In the market also it is available at 100. So basically the contract does not have any intrinsic value. So intrinsic value is 0. Can I say there is a time value of 20? Come on, yes or no? Yes. So the value is 20 rupees. Let's say, for example, now on 1st of May, the spot becomes, example, 150 rupees. Now, when the spot becomes 150 and I have a right to buy it at 100 rupees, can I put it like this? This contract inherently has some value attached to it. Come on, yes or no? Yes, sir. And this inherent value is actually called as your intrinsic value. So what will be the intrinsic value? The intrinsic value is going to be 50 rupees. That is the difference between the spot and the strike price. And also at the same time, my dear students, will there be any time value attached to it? Yes, because still there are 2 months which are left for the contract to be expired. So we are standing on 1st of May and we are talking about 30th of June. So is there any time limit attached to it? Come on, yes or no? Yes. So let's say, for example, the time limit attached is, example, the time limit attached is 2 months, and because of which the time value is coming as 15 rupees. So what will be the premium quoted? 65. The premium quoted will be 65. So also at the same time, let's say, for example, on 1st of June. Oh, now on 1st of June, let's say, for example, the spot price becomes 80. Now the spot price becomes 80. Are you seeing the fluctuations? Now the spot price have become 80 rupees. So now you will always tell me, sir, the spot price is 80 and I have a right to buy this particular contract at 100 rupees. Now this contract inherently does not have any value because it becomes out of the money. So its intrinsic value is going to be what? Its intrinsic value is 0. But still there is 1 month time for that particular contract which can become in the money as well. So will there be any time value attached to it? Yes, sir. So let's say your time value is 5 rupees. So the premium will be costing what? 5 rupees. So are you seeing that the premiums will be kept on changing till its expiry? Yes or no? Yes, sir. Because of the combination of two important things, and that is your intrinsic value and time. On 30th of June, on the day of expiry, suppose on the day of expiry, my dear students, the spot becomes 120 rupees and the call option strike price was 100 rupees. Now you will definitely tell me, sir, in this particular case, can I say that my spot is 120 and the strike price is 100? Does this contract have some inherent value? Come on, yes or no? Then the answer is yes. So what's the inherent value? The inherent value is 20 rupees, and of course there is no time value attached to it. So this itself will be 20 rupees. So I hope, my dear students, you are understanding this, that this is going to be your entire premiums calculation. Okay. So I have explained you all permutation combination just in this one example of call option. Okay. And as you all can see, first it was at the money, then it becomes in the money, then it becomes out of the money, then again it becomes in the money. So how this premium will have intrinsic value and time value component attached to it. Similarly, my dear students, now let's talk about the put option. So put option premium decoding also we can do it like this. So let's say for example, same time frame from 1st of April to 30th of June. Suppose there is a 3-month time frame and your spot is, let's say, rupees 100. So my dear students, you will be having spot of rupees 100 and your spot is rupees 100, and let's say your strike price is also rupees 100, and now we are talking about the put option. It means you have a right to pay, right to sell this particular contract for 100 rupees. You have a right to sell this for 100 rupees, but of course there is still 30th of June. So basically there is some premium which we need to pay. So let's say the premium is 20 rupees. So now it is very much evident that premium is nothing but the value of the put option is nothing but intrinsic value plus time value. So intrinsic value of this particular contract is 0, time value is 20 rupees. So your 20 rupees is your premium. Now let's say for example on 1st of May, my dear students, the spot price turns out to be 70. I have a right to sell it for 100. Wow! I have a right to sell this particular contract for this particular share for 100 rupees. And my dear students, the spot price is 70 rupees. Now, my dear students, can I say the contract has an inherent value? Come on, yes or no? Yes, sir. The contract has an inherent value of 30 rupees. Plus, the time limit is still there. There is still 2 months left for expiry. So let's say 15 rupees. So 45 rupees can be the premium. Also at the same time, let's say on 1st of June, now this price becomes 150. Okay, and the strike price is 100. Oh, what is the moneyness of this? This automatically becomes out of the money. And if it is out of the money, intrinsic value will become 0. There will be just premium attached for 1 month. Let's say that is 5 rupees. So this will become 5 rupees. Then on 30th of June, we need to check what's the spot price. Suppose your spot price on 30th of June is, let's say for example, 80 rupees, and the strike price is 100 rupees. So we have a right to sell this share for 100 rupees, and in the market this share can be sold for 80 rupees. Is this contract on expiry or ITM? Come on, yes or no? Yes, sir. So basically the premium here will be nothing but intrinsic value, and there is no time value attached. Why there is no time value attached? Because this particular contract is expiring. I hope, my dear students, you all are understanding this entire call option, put option, moneyness, and how this premium has the component of intrinsic value and time value both. Okay. Now, first we will start with some of the basic questions. We'll revise that first before we start with the advanced questions. Okay. So I just want you all to first come to your question number 70. Okay. Let us quickly revise what is given to you. Given the following data determine the value of the call option at the expiration dates. We have option A, B, C, and D. We have the market price per share on expiry, and we have the exercise price. So this exercise price is nothing but the strike price. Okay. Now, my dear students, first of all, what is given to you? We are required to determine the value of the call option at the expiration dates. Okay. At expiry, what is going to be the value of the call option? What is the market price per share? 10 rupees. What is the strike price? The strike price is 12 rupees. So I have a right to buy at 12 rupees, and the market price per share is 10 rupees. Can I put it like this? When we are talking about call option, these are the strike price. First, what do you think will be the moneyness? So when I have a right to buy it at 12, I have a right to buy it at 12. And my dear students, in the market, this share is traded at 10 rupees. Can I say the moneyness is out of the money? This particular contract becomes out of the money. Come on, yes or no? Then the answer is yes. Okay, why? Because the strike price is greater than the price on the expiry. My dear students, we have already written here. What becomes OTN when the strike price is greater than the spot for a call option? Exactly this situation when the strike price is greater than the spot on expiry. So this becomes OTN, right? Then in this particular, first let us write down the moneyness. The market price is 25 and the strike price is 21. So basically what is happening here is I have a right to buy it at 21 and the market price is 25. Wow. So in this particular case, can I say this contract will become ITM? It is going to be in the money. Why it will be in the money, my dear students? Because I have a right to buy this particular contract for 21 rupees. I have a right to buy this particular share for 21 rupees. And in this particular case, I have a right to buy it for 21 rupees. And the market price is now 25. So this becomes my in the money. Similarly, my dear students, here also you all can just check that the exercise price is 52. So the exercise price is 52 and the market price is 48. So this will automatically become your out of the money. And because it's a call option and here market price is 7, I have a right to buy it at 5. So this automatically becomes in the money. So what do you think will be the value? So my dear students, here the value is going to be what? Can I say only intrinsic value will be taken into consideration? Come on, yes or no? Yes, sir. Okay. So we are just and just going to take into consideration your intrinsic value. Okay. Okay, my dear students. So basically what will happen is that the value of the call option for OTMs will always be 0. And at expiry, as I've taught you that, what is going to be the value of in the money? So it is going to be now, can I say 4 rupees? That's the intrinsic value. There is no time value attached here. It's going to be 2 rupees. Extremely simple, my dear students. Okay. So this is how we'll be calculating the value of the call option. Now let's do question number 18. State whether each one of the following is going to be your, this is going to be now your call, put, etc. Now let us check this out. Here, what is given to you? uh, which of the following is ITM, ATM or OTM? Okay. Now it's a call option. Okay. And call option, this is your strike price. The strike price is 60 and the spot is 50. Now what is going to be your moneyness? Okay. So let us do it here only. Your moneyness. So we have to just identify what is the moneyness. Call, your strike price is 60 and the spot is 55. So you have a right to buy it at 60 when the spot is 55. This is OTM. Second, this is going to be ATM, right? Because both of them are 50-50. In the third situation, when you have a right to buy it at 110 and the spot is 105. Okay, so this is also going to be your OTM. Here you have a right to buy it at 40 and the spot is 35. This will also become your OTM. For put option, you have a right to sell it at 110 and the spot is 100. So this becomes your ITM because you have a right to sell it at 110 and the spot is 100 rupees. Can I say this is in the money? Also, if you have a right to sell it at 105 and the spot is 115, we will say this is OTM. Then, my dear students, if suppose we have a right to sell it at 12 and the spot is 15, this also becomes OTM. You have a right to sell it at 25 and the spot is 20, this becomes ITM. So, this is how, my dear students, will be describing the moneyness of the option. Now, let us do your question number 19. Now, in your question number 19, see what is given to you. A stock with a current market price of 50 has the following exercise price. Exercise price, we will call it as a strike price. And the call option premium. We are required to compute what is the intrinsic value and the time value. So as we have discussed, can I say your premium is nothing but the combination of two important things. And that is nothing but your intrinsic value and your time value. So let us now check this out. You have a stock with a current market price of 50 rupees. Okay, your strike price, and this is a call option premium. So can I put it like this? Your premium is 9 rupees. Okay, your exercise price is 45. First thing is, can I put it like this? You have a right to buy it at 45. When the spot is 50 rupees, this automatically becomes ITM. Okay, and when it becomes ITM, your premium will have intrinsic value, your premium will have time value. So what will be the intrinsic value? It is nothing but the difference between your contract strike price and the spot. So that is 5 rupees. And your premium is 9. So your time value will become 4. That's the balancing figure. Also at the same time, my dear students, let's check this out here. If it is 48, okay, and the spot is 50. So here also it's a in the money contract. And your premium is 6, your intrinsic value will be 2 rupees. How did we get 2 rupees? Because we have a right to buy it at 48 and the price is 50. So that definitely it's in the money. So that's why it's going to be 2 rupees. And this premium is 6. So this will be now become 4. Okay. Now this is 50. So this becomes your ATM. So premium is 4. So intrinsic value is 0. Entire thing is your time value. This is 52. So out of the money. Why? Because I have a right to buy it at 52. But my dear students, the spot itself is 50 rupees. So in this particular case, can I say that there is intrinsic value of 0 and the entire 3 rupees is time value. So for out of the money call options, always remember the premium is nothing but the time. If this is 55, this is OTM again. So this will now be 2. Okay, so this is what your question number 19 is. Let's now decode your question number 20. Okay. Okay. Now, what is given to you in the question number 20? A stock with a current market price of rupees 50 has the following exercise price and the put option premium. We are required to calculate what should be the intrinsic value and the time frame. Okay. So now, my dear students, the same thing we are going to deal with your we are going to deal with your put option. Now, for put option, my dear students, we definitely have here what is going to be your right to sell. These are the exercise prices which are available: 45, 48, 50, 52, 55. Okay. And your current market price is 50 rupees. This is your premium. So let us talk about intrinsic value and time. First of all, if the market price going on is nothing but 50 rupees, but the strike price is 50 and your the spot price is 50 and the strike price is 45 for a put option, this becomes out of the money. So your intrinsic value will become 0, time value will become 1. Your intrinsic value will be 0, time value will be 2. Here the intrinsic value will be 0, time value is going to be 3 because it's ATM. Here, my dear students, you have a right to sell it at 52 rupees and the spot going on is 50 rupees. So can I put it like this, that it is going to be your in the money option? Come on, yes or no? Yes, sir. So basically there will be 2 rupees of your intrinsic value and your premium is 5, which means that there is going to be 3 rupees of your time value. Also at the same time, if this is 55, this is 50, can I put it like this, that your intrinsic value is now going to be 5 rupees, and that is why your premium is now going to be 2 rupees. So this is how, my dear students, we will be calculating what is going to be your intrinsic and time value. Okay, so very easy for you to understand this. Okay, so I hope you all are at least clear with this much part. Okay, now let's continue this further. uh an equity share of VCC is quoted at 210. A 3-month call is available at a premium of rupees 6 per share and a 3-month put is available at a premium of rupees 5. Ascertain the net payoffs to the option holder of a call and a put option separately. The strike price in both the cases is 220 and the share price on the exercise day is 200, 210, 220, 230 and 240. Okay. So my dear students, for your question number 21, do I have first of all the spot available? Yes, sir. What's the spot? The equity share of VCC is quoted at 210. So I definitely have a spot which is rupees 210. Okay. And a 3-month call is available at a premium of rupees 6 per share. So there is a call option. Okay. And it's a 3-month call option. And here, my dear students, the premium is rupees 6 per share. So what is the premium? So a 3-month call premium is rupees 6 per share. And my dear students, a 3-month put option is available at a premium. So there is a 3-month put option which is available at a premium for rupees 5 per share. Okay, for rupees 5 per share. So my dear students, this is going to be your call premium. This is going to be your put premium. Okay. Now, ascertain the net payoffs to the option holder of a call and a put option separately. The strike price in both the cases is 220 rupees. So we have the strike price here of 220. Here also is the strike price of 220. Okay. Now, if suppose you are an option holder, okay, and these are the share prices, okay, on the exercise day. So basically, what is going to be your payoff? So now we are going to discuss the payoff, my dear students. So let's say, for example, your spot on expiry. What is my spot on expiry? Let us check that out. Your spot on expiry is 200, it's 210, then it's 220, then it's 230, and then it is 240. Okay, so these are the spots on expiry. Okay, let us talk about the call option first. So we have the strike price of 210. By the way, this spot is now no longer of any relevance to us. You know why? Because anyway, we are now going to check that what is the spot on expiry and what is going to be our payoff. Okay. So as you all can see that for a call option, when the strike price is 220, what is the moneyness? Can I say this automatically becomes the spot on expiry is 200 and the call option strike price is 220? It means that I have a right to buy it at 220 when the market price itself is 200 rupees. So can I say this becomes out of the money? So this is out of the money, this is out of the money, this is at the money, this is in the money, and this is also in the money. Okay, so these are the different call options. Okay, now my dear students, continuing further, what is going to be the value of call option? What is going to be the value of this call option at the time of expiry? Can I put it like this? If it is an OTM contract, of course, on expiry, its intrinsic value is going to be zero. Time value is also going to be zero, right? So it's going to be zero. So my dear students, here also when we were discussing, here though both the cases on expiry it was in the money. But let's say for example on expiry it is out of the money. So will the contract have its own intrinsic value? Then the answer is absolutely no. The contract will not have its own intrinsic value. So in this particular case, there is no time value also left. Why there is no time value which is left? Because we are anyway expiring this particular contract. So in this particular case, your OTM is going to be what? Your OTM is going to be zero. Here also your OTM will be zero. Your value of the contract is going to be zero. Here for ATM, again the value of the contract is going to be zero only. For ITM, yes, will there be any value of the contract? That will be 10 rupees. And here the value of the contract will be 20 rupees. Okay. Because there will be intrinsic value. At the time of expiry, always remember like this, that what is going to be the value of the contract? Can I say if it is in the money? Then intrinsic value. If it is out of the money or at the money, then the contract will not have its inherent value. So it's definitely going to be zero. Okay. But am I paying some premium here? Come on, yes or no? Yes. So how much premium have I paid here? I've paid a premium of 6, 6, 6, 6, and 6. So what is going to be my payoff ultimately? Can I say when the price becomes 200, my loss is 6. Here also the loss is 6. Here also the loss is 6. But here, can I say 10 rupees is the value of the call option and I had paid the premium of 6, which means that there is now 4 rupees, which is going to be my final profits. And here my final profits is going to be 14 rupees. Okay. So for an option holder, always understand like this, that if the prices fall, the maximum loss is the premium paid. I already told you this at the start. Okay. Similarly, my dear students, if it is a put option, okay. So for a put option with a strike price of, let's say 220 rupees, okay, with a strike price of 220 rupees, can I say this becomes in the money? Right? Because I have a right to sell it for 220. Okay. And the spot on expiry is 200 rupees. So this is going to become your in the money. This will also become in the money. This will become at the money. This will become out of the money and this will also become out of the money. Now, in this particular case, what do you think will be the value of the put option? If it is in the money, my dear students, can I say that 20 rupees here will be the value? Here also it is 220 and the spot on expiry is 10. So 10 rupees will be the value. Here the value is 0. And here the value of the put option is going to be 000. Why? Because it's already at the money, out of the money, the value of the put is going to be 0. Because there is no intrinsic value, neither there is any time value attached to it. So it's always going to be 0. Then my dear students, when we are talking about premium, the premium here is what? Can I say the premium is 5, which we are paying in all the cases. So what is going to be the final payoff? So final payoff here will be 15, here there will be 5, and here there is going to be loss of -5. I hope, my dear students, you all are able to understand this much part. Okay. Now, also indicate the price range at which the call options may be gainfully exercised. We have already discussed that. Okay. Now, before I continue with these questions, okay, uh, okay, I can do question number 22 also. So let me first do question number 20. Let me revise this first, because the strategies I'll do it, a little bit later, because this is very much time consuming. All the strategies are not there in your study module as well. So we'll be doing selected strategies. Okay. But if I do it right now, then I'm very sure that you will be bored immediately. So let me not do the strategies right now. First, let me now complete this part. See, Mr. A purchased a 3-month call option for rupees for 100 shares in XYZ at a premium of rupees 30 per share. And what is the exercise price? The exercise price is rupees 550. And he also purchased a 3-month put for 100 shares of the same company at a premium of 5 with an exercise price of 450. So you know what is happening? Mr. A is long in call option also, and he's long in put option also. So Mr. A has actually purchased call option and put option both. Okay. The market price of the share on the date of Mr. A's purchase of option is 500. Calculate the profit or loss that Mr. A would be assuming that the market falls to 350 at the end of 3 months. Okay. So first step is always what? That we always write down the data which is given to you. So here in this particular case, you all can just check that there is a 3-month call option. Okay, there is a 3-month call option, and this 3-month call option actually has a strike price of 550. So we have a strike price of rupees 550. Okay, and here you also purchase a 3-month put option. Okay, but first of all, how much premium is he paying? He is paying a premium of rupees 30 per share. Fine, chalo, no problem. So the premium paid is rupees 30. Now let us continue further. You will see that he also purchased a 3-month put option. So there is a 3-month put option also which is being purchased. And here the strike price is again 550 rupees. Okay. No, with a exercise price of 450. So here the strike price is 450. Okay. And here, my dear students, you all can just check the premium which is being paid is nothing but premium, which is being paid. That is nothing but 5 rupees per share, right? 3-month put option for a premium of 5 rupees, and the exercise price is 450. So here the premium paid is rupees 5. Perfect. Now, my dear students, the market price of the share on the date of Mr. A's purchase of the option is rupees 500. Okay. So market price of the share on the date of Mr. A's purchase of option is 500. Market price of share. So basically, when we are purchasing this option, then the market price was 500. But we are not concerned with that. Why? Because we are required to calculate the profit or loss when the price falls to rupees 350 at the end of 3 months. So at the time of expiry, what is the spot on expiry? The spot on expiry is rupees 350. Now, in this particular case, you have two positions. One is your call option and another is your put option. Okay. Now, my dear students, there is call option, there is put option. Let us talk about your call option. In your call option, my dear students, as you all know that we have your strike price of 550. So we have a right to buy it at 550, but the spot on expiry is 350. Automatically, this becomes out of the money. And when it becomes out of the money, can I say the value of the call option is going to be the 0? And similarly, here we have a right to sell it at 450, and the spot on expiry, the market price of equity share on expiry is 350. Can I say this becomes in the money, and the value of the put option here is going to be 100 rupees. Okay. The value of the put option here is going to be 100 rupees. Now, my dear students, what is the premium? The premium paid here is 30 rupees and the premium paid here is 5 rupees. So in this particular case, there is a loss of 30 rupees here and here there is a profit of 95 rupees. Ultimately means what? Can I say there is a 65 rupees profit? Come on, yes or no? Then the answer is yes, sir. Okay. And my dear students, if you calculate this in your number of equity shares perspective, because there is one lot is 100 shares under both the cases. So as in futures, the every derivative contract had some part of your, whatever was your market price. Similarly, here also a lot size. Here also we are going to have a lot size. So basically, this 30 I can multiply it by 100. Okay, so there is a loss of 3,000, and this if I multiply it by 100, there is a profit of 9,500. So ultimately, there is a total profit of 6,500. Okay, so something like this also we can present it. Fine. So this is what we are going to deal with in your question number 22. These are all your strategies. Okay, but before I start with this put call parity, now first I want you all to understand something with regards to your riskless model and your risk neutral model. Okay, so first we'll discuss this. The two valuation models, okay, riskless and your risk neutral models. Okay, so let us first start with your riskless models. Okay, fine. Chalo. Now, riskless model, my dear students, basically, as you all know, that when we are going to deal with valuation of the options, so this valuation of the options basically is divided into two main parts. The first one is called as binomial options, binomial methods for the purpose of valuation, and the second one, which is called as a Black and Scholes. Okay, so binomial option basically has your riskless model, and this also has your risk neutral model. Okay, so your riskless or risk free is the same type of a model where we use the concept of H. That is nothing but your you can take into consideration what should be your delta. So your basically hedge ratio can be used for the purpose of calculation, and in this case we will take the concept of probabilities PU and PD. And Black and Scholes, my dear students, as you all know, will be doing the formula for the same. Okay, so let us first talk about your binomial models for risk free. Okay, now in this particular case, my dear students, we have a concept of creating a portfolio of shares and selling a particular call option for the same. See, basically, how does this riskless model comes? The riskless model is basically based on an idea that if you know the spot price is, let's say for example, 100 rupees, and the price either becomes 120 or it becomes 80 rupees. Okay, then the value of the portfolio at the end of year one. Okay, so value of the portfolio at the end of year one is going to remain the same irrespective the price is reaches 120 or the price reaches 80. Okay, so the value of the portfolio is going to be the same. So we are actually creating a portfolio by entering into a call option, by entering into a spot, by entering into a long position in the spot and selling a call simultaneously. So on this basis, a portfolio will be created. Now this portfolio is going to be risk free irrespective of whatever is going to be the market price on expiry. So we will introduce the shares, we will buy the shares and sell the call in that particular proportion that the entire portfolio becomes risk free, riskless. That's why it's called as riskless model. Okay. So in riskless model, what comes to your mind first of all, that whatever is the price at the end of year one, can I put it like this, that the value of the portfolio is going to be the same? Come on, yes or no? Yes, sir. Okay. So that's why we call it as risk free, riskless. Okay. So this is something which we'll do it with the help of an example. But first, let us read this question number 33. Okay. Now, what is given to you in question number 33? Your equity share is currently selling at rupees 80. So do we have the spot price available? Okay. So now I'm just revising this question number 33. So we have a spot price. What is the spot price which is available? It is rupees 80. Okay. The spot is rupees 80, and in a year's time, it can rise by 30% or fall by 15%. So this price can rise by 30% or it can fall by 15%. So what can be the price here? 80 plus 30%, it can be 104, or 80 minus 15%. So this can become 68. Okay. So this can be the price or spot on expiry. Okay, so these are the two possibilities. Okay, it can go to 104 or it can go to 68. Now, please be with me, solve with me. Okay, The exercise price of the call option of the share is rupees 90. So we have the strike price, which is nothing but rupees 90. And this is a call option. Okay. This is a call option. And what is the value of the call option if the risk-free rate is 8%? So we have your R as 8%. Okay. And now we need to use binomial riskless model. Okay. Now, first of all, my dear students, when I talk about value of the call option at the end of 1 year, because we are talking about 1 year's time. So the expiry is 1 year. So when we are talking about 1 year's time, what is the value of the call option? Can I say that if suppose I have a right to buy something at 90 rupees and on expiry, if this becomes 104. So I have a right to buy it at 90 and on expiry it becomes 104. So in this particular case, can I say 104 minus 90, the value of the call option is going to be 14 rupees. Okay. And here in this particular case, if it is 80 and in the market, if it is available at 68 rupees, then your value of the call option is going to be 0. Okay. So value of the call option is 14 and the value of the call option here is going to be 0. So these are the two possibilities. Okay. Value of the call option can be 14. The value of the put option, the value of the call option here is going to be 0. Okay. Your risk-free rate, your R is nothing but 8%. Okay. Now, what we need to do? The first step is like we are going to create a portfolio today. Okay. So let us say that create a portfolio today. Okay. By investing in equity shares and selling one call option. Okay. So basically, what are we going to do? Is very simple. We will be creating a portfolio, and this portfolio will be created by investing in equity shares today. And to protect this particular portfolio, what we'll be doing, we'll be selling the call option. See, automatically what happens is that, when we are creating a portfolio, when we are long and we are also selling a call option, it means that in a portfolio we are having a bullish and bearish view both, because selling a call option is your bearish view. So basically, we are actually creating a portfolio which is hedge free, which is risk free. So we are hedging it. In what way? That we are buying some number of shares. So the spot price is 80 rupees. So guys, the spot price, uh, if it is 80 rupees, okay, and my dear students, let us invest in H number of equity shares. So suppose H number of equity shares we are investing, so portfolio is 80H, and we'll be selling one call. So when we'll be selling one call, can I say we'll be receiving some premium coupon, yes or no? Then the answer is yes. So 80H minus C, can I say that is nothing but the value of portfolio today? Okay, so your value of portfolio today is nothing but 80H minus C. Okay. Now, my dear students, okay, let us see that what can be the value of the portfolio at the end of year one. Okay, so what will be the value of portfolio at end of year one? Now, at the end of year one, can I say that the stock price is going to become what? 104. So basically, in your first situation, it's going to be 104. Multiply that by the number of shares which I'm going to have in my portfolio. So I'm having H number of shares. So 104H. And of course, I'm selling one call also. So that is why I'm going to receive some premium on the same. So 104H minus C. So this is going to be the value of the call option. Okay. And I already have the value of the call option at the end of year one, and that is nothing but 14. Okay. So this is 14. So basically now my value of the portfolio towards the end of year one is going to be what? 104H. Okay, because I am investing in H number of shares. Okay, so that's an assumption. So let us invest in H shares. Okay, so H number of shares we are investing. So can I say 80H? That is going to be my value of the portfolio today, 80H, and I've sold one call. So that is why premium received, I'm going to subtract it. So value of the portfolio today is 80H minus C. What is the value of the portfolio at the end of year one? So at the end of year one, value of the portfolio will be when the price becomes 104. So this will become 104H. That is nothing but the number of equity shares which we have, and minus what is the value of the call? The value of the call is nothing but 14 rupees. So my portfolio will have 14 rupees. So that is why 104H minus 14. So this should be equal to what? Can I say here it should be 68H minus 0. So in this particular case, what is going to be the value of the portfolio? See, when we are talking about a risk-free portfolio, you always have to understand that risk-free or risk-less portfolio, here we are always going to have, irrespective of the market price, the value of both the portfolios have to be the same. Okay, because that is why we call it as a risk-free. Okay, so then in this particular case, 104H minus 14, the value of the portfolio here should be equal to 68H minus 0. So that is the value of the portfolio if the call is going to be out of the money. Now, is this situation sufficient for me to calculate what should be your H number of equity shares? Come on, yes or no? Yes, sir. So here, my dear students, we can calculate this 104H minus 14. This should be equal to 68H. So now this will be 104 minus 68. That will give you 36H is equal to 14. So what's your H? It's going to be 14 divided by 36. That is 0.3888 shares. So you know what is the meaning of this? The meaning of this is, my dear students, we should buy 0.388 shares and sell one call. So this is what we are going to do in your riskless model. This is the perfect hedge situation where we are going to buy 0.338 shares and we'll be selling one call. So when we do that, automatically, can I say the portfolio will become risk free? So whatever is going to be the value of the portfolio towards the end, whether the price will go up or it will come down, obviously the value of the portfolio is going to be the same. Okay. So of course, now you'll wonder, okay, sir, how can we buy 0.338 shares? So for example, they tell you that for 100 calls which you want to sell, how many shares you want to buy? So can I say this will now become 100 into 0.388888. So that will be nothing but 38.88. So we have to buy 38.88. So approximately 39 shares we need to buy. So if you create a portfolio by buying 39 shares in the spot, okay, and selling one call, then automatically, my dear students, and by selling 100 calls, automatically your portfolio will be hedged. Your portfolio is going to be in such a situation that it is completely going to be risk free at the end of year one. Whatever is the market price, the value of the portfolios are going to be the same. Okay. So now our objective is not to find out this. Okay. By the way, this 0.338 shares for, selling one share can also be calculated with the help of your hedge ratio, and this hedge ratio can also be calculated. So this is just an alternative. It can also be calculated by whatever is your swing in your option. We can divide that by swing in whatever is the stock price. So you all can just check what's the swing in the option. Can I say from 14 to 0? Swing means by how much, what is the range on the basis of which this particular call option can move. So from 14 to 0. So can I say that your swing in the call option is 14, and what is the swing in the stock? So your swing in the stock price is from 104 to 68. So you all can just check, it's 36. So now, my dear students, if I take 14 and if I divide that by 36, this will give me same 0.33888 is to 1. I hope you guys are trying to understand this. So this will be nothing but what is going to be your call option. Okay. So you can do it like this. Okay. So for every one share, it's going to be 0.3888 is to 1. Clear, my dear students? Okay. So is this going to be your hedge ratio? Come on, yes or no? Yes, sir. So for every one call which you are selling, these are the number of shares which you are buying. Number of shares. So this is a very shortcut way to do it, or else you can do it like this as well. But I just wanted to prove it. Why do we call it as riskless or risk free? Is because we assume that the value of the portfolio at the end of year one is going to be the same. Okay. So that's why we call it as risk free. Okay, fine. Now coming back here. So ultimately I've got my H. Can I substitute my H and calculate the value of the portfolio at the end of year one? Yes. So my third step is, let me now substitute H to calculate the value of portfolio, at end of year one, the value of portfolio at the end of year one. So in this particular case, this will now be 104 into what is your H? 0.3888 minus what's your call option? So your call option value is 14. Okay. And my dear students, this is equal to 68H, right? So 68H, your H is 0.388, and this I'm going to subtract by 0. So in this particular case, we will take 104 into 0.38888 minus 14. So this gives me 26.44. And my dear students, this will be 68 into 0.3888. So this will also be 26.44. So in this particular case, my dear students, can I put it like this? That value of the portfolio is coming equal at the end of year one at this hedge ratio. Yes or no? Then the answer is yes. But we need to find out what is the value of the call today. So what we need to find out, what is the value of the call today? What is the value of the call? Okay, so that is the most important thing. What premium which we need to pay today? So how will I do this? So now, my dear students, I have the value of the call at the end of year one. Okay, I have the value of the portfolio at the end of year one. So can I put it like this, my dear students, that if if this is 0, this is 12 months. Now, my dear students, for 12 months, for 12 months, let's say for example, I have at the end of 12 months, suppose this is the value 26.44. If I want to find out the value today, so in that particular case, it will be 26.44. I have to discount it and bring it to the present value term. So I will take 1 divide by 1 point. What's the discounting factor? Your discounting factor is 8%. So this will now be 0.08. Okay, so this will be 0. 1 plus 0.08. So ultimately, my dear students, we will take 1 divide by 1.08 and multiply that by 26.44. So eventually we'll be getting 24.48. So what is 24.48, my dear students? Can I say 24.48 is nothing but the value of portfolio today? Come on, yes or no? Then the answer is absolutely yes. So it is nothing but the value of portfolio today. So value of the portfolio today is 24.48. Now, my dear students, we have the value of portfolio today, which is nothing but 24.48. Now, do I have what is the first step value of the portfolio today, which is nothing but 80H minus C. So here, value of the portfolio today, which is 24.48, is equal to 80H minus C. So 24.48 is equal to 80 into what is your H? Your H is nothing but 0.388, okay, and minus C, okay. So this will now become 80 into 0.3888. So this will give me 31. So 24.48 is equal to 31.104 minus C. So what is your C, my dear students? From this, if I subtract 24.48, eventually I'll be getting 6.62. So finally, my dear students, what we have actually got is the value of the call option today. So they have told you what is the value of the call option. So value of the call option today is nothing but 6.62. So this is what we do, my dear students, in your risk-less model. This is the entire process, your entire steps. So when I wanted to revise, I just wanted to make sure that I solve this particular question in front of you so that you understand what's the process. First, what we need to do, what is the objective, what can be the value of the portfolio towards the end, how can we calculate the call option, what are the different ways. So I've explained this very thoroughly, in both the cases, by hedge ratio also and by this also. So on both the ways, you will be getting finally, this is 0.388 and this will be so 26.44. And then, my dear students, this is 24.48, value of the portfolio today. So eventually, my dear students, this will be nothing but 6.62. Okay. Are you all comfortable till this much part? Okay. Now, my dear students, all these things we have discussed. So apparently, okay, your question number 33 is over. Let us do one more question on your risk-free model. Okay, so that your risk-free model gets completely over. There are two questions for the same, and both the questions will be revising it. Okay, so a stock currently trades at a price of $100. Okay, and the stock price can go up by 10% and can come down by 15%. The risk-free rate is 6.5%. Use one period binomial model to calculate the price of a call option with an exercise price of $90. Okay. So my dear students, now in your question number 34, what we need to do is that we first have to write down what's the spot. The spot price is $100. Okay. The stock price can go up by 10% or can come down by 15%. So this can go up, this can come down. This can go up by 10% and this can come down by 15%. So my dear students, this can be 110 or this can be $85. Okay, so this can go to 110 also, and this can go to 85 as well. Okay. Now, my dear students, what do you think? What do you think will be your? This is the price at end of year one. Okay, this is the price of end of year one. So, what is the value of the call here? So here the value of the call will be $10 because this will become in the money, and here the value of the call is going to be 0. Okay, and this is going to happen at the end of year one only. Okay, so using one period binomial model, you require to calculate the call option at the strike price of $90. So when the strike price is $90, what do you think? What do you think should be the value of the call today? Okay, so that is something which we are required to calculate. So now that previous question, I explained you completely with all the steps. Now see, I'll teach you something in which the question can be solved so easily. First thing is I will calculate what is the value of portfolio today. So can I say my value of portfolio today? I will create a portfolio which should be risk free today. That will be, can I say the spot is $100. So I will invest in $100 with number of shares H, and then I will be subtracting C. Okay, so I'll be subtracting C. So that is nothing but the premium. So I'll be subtracting C part. So value of the portfolio today is $100H minus C. Okay. Now, my dear students, if I'm talking from the perspective of, if I'm talking from, this is the value of the portfolio today, $100H minus C. Now, if I want to calculate what should be the value of portfolio at end of year one. Okay. So obviously you all know that it can be $110H minus C, and we have the value of the call option there, which turns out to be $10. Okay. And my dear students, this will be equal to $85H. Okay. And minus 0. Okay. Now in this particular case, my dear students, we have $110H minus $10 and $85H minus 0. Okay, so this is nothing but my value of the portfolio towards the end. Now, my dear students, this is the value of the portfolio. Now, coming back to our particular hedge ratio, can we do this by taking what is the percentage swing in option, which I will divide it by percentage change in stock. So what is my percentage change in option? So my dear students, your percentage change in option is now going to be, can I say this is $10 and this is 0. So this is going to be, the change, matlab that delta, that change in option upon change in stock. So that is 10 upon, and can I say that here it is 110 minus 85. So this is nothing but 25. Okay. So 10 upon 25, will this give me the hedge ratio? Come on, yes or no? Yes. So 10 divided by 25, my hedge ratio will be 0.4:1. So I need to now sell one call, and for that I have to buy 0.4 shares. Okay. Now let me see whether what I've done that's correct or not. Because if I now know that I have to buy 0.54 shares, so $110 into zero point 0.4 minus $10, this should be equal to $85 into zero point 0.4 minus 0. So 110 into 0.4 minus 10, that is nothing but $34, and this will be equal to 85 into zero point 0.4, and that will be nothing but $34. So in both the cases, my dear students, can I say that I'll be having the value of the portfolio towards the end, that is $34 itself? Come on, yes or no? Then the answer is absolutely yes. So it's going to be $34. Now, my dear students, once we get your $34, then this $34 is towards the end. So it is towards the end. So this is 0, this is 12. This is $34 towards the end. So what should be the price today? So now in this particular case, the price today, for that I have to take the discounting and bring it to the present value term. So $34 into 1 divided by 1 plus, what's the risk-free rate? The risk-free rate, my dear students, what is given to you in the question is 6.5%. So 0.065. So in this particular case, 1 divided by 1.065, and this if I multiply it by 34, so this will be $31.92. Okay, so $31.92. What is $31.92, my dear students? This is nothing but, can I say that whatever is the value of the portfolio today, come on, yes or no? Then the answer is yes. So my value of the portfolio today is nothing but $31.92. So this is my value of portfolio today, which will be $31.92. Now, my dear students, how are we going to do the calculations part? So the value of the portfolio today, as you all know, is 100H minus C. So this is 31.92 is equal to 100H minus C. So will this give me now what is going to be the call option price today? So what is your H? Your H is nothing but 0.4. So I'll be now taking this as 0.4 and minus your C. So this will be 31.92 is equal to 40 minus C. So now your C will be 40 minus 31.92, which will be nothing but 8.08. So is this the value of your call option today? Come on, yes or no? Then the answer is yes. See, very easily we can do it under riskless model with the help of the hedge ratio. Then we calculate what is the value of the portfolio towards the end. Once we get the value of the portfolio towards the end, then very easily, my dear students, we can calculate your H and the value of the call option. And based on this, my dear students, once we get the H, we can substitute that in the value of the portfolio today and finally get what can be the value, which is nothing but 8.08. So I hope, my dear students, you have understood this entire concept about riskless model very, 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 very thoroughly, about how do you calculate H, etc., everything. Okay. And now, what is the second part? Suppose the call price is currently $17.5. Okay. So what is the actual price? So in the second part, my dear students, we have the actual price of call option, which turns out to be $17.5. Okay, so that is $17.5. So we have the actual price of the call option, which is $17.5. And what is the value of the call option? So value of the call option have they given to you? Uh, just give me 1 second. Okay. Hmm. 1 second. Just in this particular question, we are actually having, what is your ratio? 1 second. This is 110 and this is 85, right? So apparently this should be coming as, oh, the strike price here is 90, my dear students. So here it is 20, okay, because the strike price is 90. So automatically here it's going to be 20. Why? Because I unfortunately compared this with the spot, but we have to compare that with the strike price, and the strike price is 20. Okay. So that is why, my dear students, now this is going to be 90 minus 110. So value of the call is 20 and 0. Okay. So this is now going to be $20. Okay. So one slight change which I want to do in my solution. This is 20. And this will now become, my dear students, 20, divide that by, what is the change in the stock from 110 to 85? This is now going to be 25. So this ratio will now be, instead of 0.4 is to 1, 20 divided by 25, this is 0.8 is to 1. Okay. So 0.8. So just one small calculation error here. For value of call option, we have to take $20 because we have to compare that with the strike price. So I compared that with the spot price, thinking that it's the same. So strike price and spot price both are different. So value of the call option on the expiry will be what? $20, obviously. Okay. So now coming back here, this is going to be 0.8. So I'll just make these changes. So this will now be zero point 0.8 and zero point 0.8. So ultimately, this is now going to be your 110 into zero point 0.8 minus this is 20. So this will now eventually be 68. Okay. And this is also going to be 68, which is 85 into zero point 0.8. So that's also going to be 68. And eventually what is going to happen is this 68, which is coming at the end, we have to discount it and bring it to the present value terms. So this 68, when I bring it to the present value terms, ultimately what is going to be the present value? So 1 divided by 1.065, if I multiply that by 1 divided by 1.065, if I multiply that by 68, I'll be getting 63.85. Okay, so this is 63.85. 63.85. So this is the value of the portfolio today. So I will take here 63.85. Okay. And eventually, if this is also 63.85, let us now find out what is the value of the call option. Okay. So we have to compare always with the strike price, not with the spot, right? To get the value of the call option towards the end, right? So that's what we do. So this will now be zero point 0.8. Okay. And this is 63.85. So this will now be 63.85. This will be is equal to 80 minus C. So what's your C gonna be? 80 minus 63.85. So that is eventually going to be 16.15. So $16.15. Is this going to be the value of the call? Come on, yes or no? Yes. So that is $16.15. Now just check, is there any arbitrage opportunity possible or no? Because you guys can just check that the actual price of the call option is $17.5. And my dear students, the value of the call option is $16.15. It actually means that your call option is overpriced. So whenever things are overpriced, what is the next thing which we do? Can I say that we will be now selling call and then we will be investing in stocks? Come on, yes or no? Then the answer is yes. So now the time has come, my dear students, that we have to do the arbitrage profits. Okay. So first we'll write down here, since actual market price of call is greater than its theoretical value, then the call options are overpriced. And when the call options are overpriced, what is the strategy? The strategy is to sell calls, okay, and invest in shares in spot market. In spot market. So that's what they have told you here also. Suppose the call price, show how an arbitrage transaction can be earned, but we have to now use 10,000 calls. So now basically, my dear students, we are going to sell 10,000 calls. What was your hedge ratio? Your hedge ratio was 0.8 is to 1. So when we are selling 10,000 calls, automatically, what are we trying to understand? Can I say that we are actually buying 8,000 shares? Come on, yes or no? Then the answer is yes. We are selling 10,000 and we are buying 8,000 shares. So this is something which we are going to do. Selling 10,000 and then we are going to buy 8,000 shares. Now, my dear students, at day 0, what will happen? Okay. So first, at day 0, to calculate the arbitrage profits, I'll just revise this with you. First, we are going to sell 10,000 calls. Okay. And we are going to buy 8,000 shares. Okay, guys. Now, when we are going to sell 10,000 calls, okay, so is there the premium which will be received? Come on, yes or no? Yes, sir. The premium received is, my dear students, the premium received here is your actual market price of the premium, which is 17.5. So now this will be 17.5. So ultimately this will be 10,000 into 17.5. So this will be 1,75,000. Can I say 1,75,000 is the premium received? Is this your inflow? Come on, yes or no? Yes, we are buying 8,000 shares at spot, which is 100 rupees. So my dear students, will be taking 8,000 and multiplying that by 100. So that will give you 8 lakh rupees. So eventually what is going to happen, my dear students? Are we going to have this as an outflow and this as an inflow? So will there be any net outflow? Come on, yes or no? Yes, sir. And that is going to be finally 6,25,000. Now, obviously, an arbitrager never has any money amount available. So, what the arbitrager is going to do? Can I say it's going to borrow this? Come on, yes or no? Yes, sir. So, at day zero, we will borrow $6,25,000 at 6.5% rate of interest. So, we are going to buy this at 6.5% rate of interest. Okay, which is given to you in the question. Now, my dear students, we are done with this particular part. At the end of, let's say, your uh, day 90, because or it's, I think, 1 year contract. Okay, so let us talk about your end of day 365. What is going to happen now? Okay, so now, my dear students, the spot on expiry can either be as you all can check, it can either be, in the question only they have told you, it can either be up by 10% or go down by 15%. So it can either be $110, or, my dear students, the spot on expiry can actually be $85. Okay, so these are the two possibilities which are there. Now, my dear students, if the spot on expiry is $110, so we'll be selling shares. So sell shares at $110. So ultimately $110 into 8,000 will eventually give you 8,000 into 110. So that will be $8,80,000. Okay, so is this going to be your inflow? Come on, yes or no? Yes, sir. Now, my dear students, we are selling shares. The inflow is 8,80,000. What is going to be the value of call? So your value of call, my dear students, value of call, when it becomes 110, can I say that? Can I say value of call which we have got here at the end of year one is going to be $20? Now, when it is going to be $20, mind you, my dear students, we are a seller of call option. See, guys, we are selling call and we are buying shares. So when we are selling call and the value of call is $20, is it a profit for you or it's a loss for you? Then the answer is, my dear students, it's a loss for you. Because an option writer will always bear a loss if the call is out of the money, if the call is in the money. So I am the option writer, you are the option holder. You have a right to buy it at $90. When the price becomes $110, of course you will come. And of course you will come and you are going to buy this particular call from me. Come on, yes or no? Yes, sir. You are going to buy this call. And in this particular case, if I'm a seller of a call, the value of the call is positive. So for a seller, it's actually your loss. Are you guys trying to understand this? So that is why, my dear students, always and always remember like this. If it's a in the money call, for option holder, he will definitely execute it because it is profit for him. But for an option writer, don't you think that's a loss? Come on, yes or no? Yes. And we are a seller of a call. So if you are a seller of a call, can I say that whatever is the value of a call, that's a loss for you? So what is the loss for you, my dear students? Value of call is $20 multiplied by 10,000. So that is why the loss for you is $2 lakhs. So now you must be wondering, okay, sir, still we are having an inflow of 6,80,000. Yes, I'm okay with this. There's an inflow of 6,80,000. But also, my dear students, we had borrowed 6,25,000 at 6.5% rate of interest. So don't you think now we have to repay the loan also? With this inflow will be repayment. We'll be repaying the loan also. Come on, yes or no? Yes, sir. So that will be $6,25,000. And to this, I am going to add 6.5%. So 6,25,000 If I add 6.5% to it, my dear students, this will ultimately become what? $6,65,625, which means that there is going to be a loss. So what there is going to be an arbitrage gain. So what is the arbitrage gain, my dear students? From this, if I subtract 6,80,000, what do I get is 14,375. Is this the arbitrage gain which I'm going to get? Come on, yes or no? Yes, sir. The same thing will apply here. When the spot on expiry is 85, so I'll be selling shares $85 into 8,000. So this will now be 85 into 8,000, that is 6,80,000. Value of call option at that time is zero. So this is going to be zero because it's going to be out of the money. So there is not going to be any loss for the option writer. So your inflow will be 6,80,000 and your repayment of loan is 665, 625. Ultimately, my dear students, there is an arbitrage gain of 14,375. So come what may, are you still going to earn the arbitrage gain? Come on, yes or no? Then the answer is yes, sir. So I hope you have understood this entire process. Okay. So first we have to identify what is it. Is it an overpriced stock? Yes. In overpriced, what do? We'll be selling that contract. We'll be selling the options and we'll be taking a long position in your spot market. So when we are buying, so we are buying 8,000 shares at 8 lakh rupees and we are selling. So we are going to receive premium of 1,75,000. So ultimately, my dear students, this is the inflow, this is the outflow. So it's 6,25,000. Now I have become an option writer in this question. So what is happening is that when the spot price becomes 110, the call option automatically becomes in the money. So the option buyer will execute the contract. So I have to oblige with it because I'm an option seller. So then whatever is the premium, what is the value of the call? That's my loss. So I'll take $20 into 10,000. So this will be your 2 lakhs and then ultimately 6,80,000 is going to be my inflow. And my repayment along with loan. So that is 6,655. So ultimately arbitrage gain is of 14,375. Okay. In the third situation, they have told you that if it is $14, then what will happen? Now, in this particular case, it will is going to be exactly reverse because $14 is going to be the market price, and according to you, the value of the contract is $16 something. So it means that it is going to be underpriced. So we are going to buy. We will be buying the particular call option. So we'll be buying the call option. We'll be selling the stock. Okay. Now I'm not doing that, but I'm just making you understand. We'll be buying the call, we'll be selling the stock. So when we'll be selling the stock, we'll be receiving the money. What will you do with that amount of the money? Are we going to lend it and earn interest on it? Come on, yes or no? Then the answer is yes, we'll be earning some interest. So that's the process which we are going to follow. Okay. So my dear students, this is something which we'll be doing your question number 33 and question number 34. Now, let us do with your risk neutral model. Okay. Now let us discuss with your risk neutral model. Okay. So now in your risk neutral model, okay, we are going to deal with your probability. So I'll be solving one question of your risk neutral model as well. So which will make you understand this entire concept very thoroughly. Okay. Now this particular model is based on the concept that uh, whenever the price of a particular stock is determined, that is nothing but the expected price of future estimates discounted and brought to the present value terms. Okay. What do I mean by this is, let's say for example, you think that if you start with your business right now, okay, so you will be earning some cash inflows at the end of year one and at the end of year two. At the end of year one, let's say for example, at the end of year one, you are earning a cash flows of let's say 5 lakh rupees, or you can earn a cash flow of example 3 lakh rupees as well. Okay. So what is the probability that you can earn cash flows of 5 lakh rupees? Suppose the probability you can earn cash flows of 5 lakh rupees is 60%. What is the probability you will earn the cash flows of 3 lakh rupees? Suppose that is 40%. So probability you will earn the cash flows of 5 lakhs, that is 60%. The probability you will earn the cash flows of 3 lakhs, that is 40%. And this is at the end of year one. Suppose I tell you that if my discounting factor is 10%, what is the present value of cash inflows which I'm expecting. So you'll be like, sir, it's so simple. First of all, there are two situations. We have probabilities of both the situations, zero point 0.6 and zero point 0.4. Here my cash inflows are 5 lakhs. Here my cash inflows are 3 lakhs. So basically this means I'll be having the average of 3 lakhs and 1 lakh 20,000. Okay, so this will eventually give me 4 lakh 20,000. Okay, so 4 lakh 20,000 is going to be my expected cash flows, but this expected cash flows is going to be at the end of year one. So what is going to be the present value? What is going to be the cash flows today? So we'll be taking 4 lakh 20 into 1 divided by 1 point discounting factor. So this will be 4 lakh 20,000 into 1 divided by okay, 1 plus what is the discounting factor? 10%, so 0.1. So this will now be 1 divided by 1.1, and this I'll multiply it by 4 lakh 20,000. So what's my present value? 3 lakh 81,818. So basically the present value of cash inflows today, which is 381,818, is actually derived by this concept. Okay. So similar to that, my dear students, pertaining to stocks also, this model is based on exactly the same concept. Let's say, for example, the share price of a particular company can become 500 rupees, or the share price of a particular company can become 400 rupees. The probability of this going up is 70%. The probability of this coming down is 30%. Okay. And if I tell you that this is happening at year one, what should be the price of the share today? What should be the current market price today? So then what will you think? Yes, sir, what's the discounting factor? Suppose discounting factor is 10%. So what will you do? You will take 500 into zero point 0.7, plus you will take 400 into zero point 0.3, and this entire thing you will take 1 divided by 1.10. Matlab you have to discount it. So this will be the current market price, right? So 500 into zero point 0.7, then 400 into zero point 0.3. The total is 470, and 1 divided by 1.1 into 1 divided by 1.1 into 470 will eventually give you 427. So your current market price is 427. So sometimes, you know what they will give it to you? They will give you the data where the current market price is 427.27. They will tell you that the price can go up to 500 also, and price can go down to 400 also. What is the probability of price going upwards, and what's the probability of price coming downwards? Can we calculate the same? Come on, yes or no? Yes, by using this formula. Yes, I've just taught you the formula by just explaining you the logic. What will be the formula for this? Your current market price is 1 divided by 1 point discounting factor into whatever is your price at the end of year one, that is 500 rupees. So this will be now estimated price at end of year one into probability of price going upwards, okay, plus what is going to be the estimated price at end of year one, and I will multiply that by probability of price going downwards. Okay. And then, my dear students, I'll multiply that by 1 plus 1 upon 1 point discounting factor. And will this eventually give me what should be the current market price? Come on, yes or no? Yes, sir. So then we can assume the PU to be X. So your PD will be 1 minus X. And based on this, my dear students, we can definitely calculate what can be the probability of price going upwards and downwards. So now you will be wondering, sir, why is that important then? That is important because if you want to find out the value of the call option today, then you will find out this value of call option by taking 1 divided by 1 point discounting factor. So this is at year 0 if you want to find out the value of the call option. Then this will be whatever is the value of call at end of year 1. We'll multiply that by probability of price going upwards, plus what is the value of call at end of year 2, year 1, multiply that by probability of price coming downwards, and on this basis we can get the value of the call option today. And the beauty of this model is we can also find out the value of the put option by using the same formula. So riskless model, we cannot find out the value of the put option based on the riskless model. We can just calculate the value of the call option. And then the next thing what you need to do is, once we get the value of the call option, the next thing what we need to do is, we have to take into consideration, uh, you know, uh, the put call parity theorem, and on that basis we can calculate the value of the put option. But here, my dear students, we can calculate value of call and value of put both using the probability of price going upwards and downwards. So your risk neutral model is much more advanced, a better method to calculate what can be the value of call and put. So basically, it considers time value of money, discounting it and bringing it to the present value terms. So this risk neutral model, we will solve one question which is very exhaustive, and that will cover all your types. So basically here, consider your 2-year American call option with a strike price of rupees 50 on a stock, uh, the current price of which is also rupees 50. So basically, my dear students, when I'm revising this question number 35, okay, what is given to you? That here we have the current market price which is 50 rupees. Okay, fine. So we have the spot which is 50 rupees, current market price is 50 rupees. Now let us see the strike price. Here the strike price is also 50 rupees. Wow. Okay, fine. So strike price also 50 rupees. So there is no chance of any error which we had done in the previous part. Okay, so this is going to be the same. So that will be 50 only. Okay. Now my dear students, there are two possibilities, that the price can go up or the price can come down. Okay. Now, as you all can check, assume that there are two time periods of 1 year, and each year the stock price can move up or down by the equal percentage of 20%. The risk-free rate is 6%. Okay. Now, my dear students, what is going to happen here? Okay. So here it is going to be year one, and here there will be year two. Okay. So they have told you that the price can, in each year, the price can move up or go down by equal percentage of 20%. So the price can go up by 20% or the price can come down by 20%. Okay. So this can be 60 and this can be 40. Now again, the price can go up or the price can come down even in year two. So in year two, if I add 20% to this will become 72, and 60 minus 20%, this will now give me 48. Okay. Similarly, here also, my dear students, there will be plus 20% minus 20%. So this will be 40 plus 20%. So that will be 48. And this will be 40 minus 20%. So this will be 32. Okay. So this is now going to be your year two. So what do you think now will be the value of the call at the end of year two? Let's talk about at the end of year two. The strike price is 50. And if suppose the price on expiry is 72. So can I say the value of the call at the end of year two is going to be 72 is nothing but the price. Okay, so I have a right to buy it at 50, but the price is 72. So it becomes in the money. My value of the call is going to be nothing but 22. Okay. Similarly, my dear students, if this is 50 and this is 48, can I say that I have a right to buy it at 50, but the price is 48? Here it's going to be 0. Here also it will be 0. And here also it's going to be 0. Okay. So this is the value of the call. Now, do I have what is the probability of the price going upwards and what is the probability of price coming downwards? Do I have that in a risk neutral model? That is very important. So what is the probability of price going upwards and the probability of price coming downwards? I don't have this. Okay. So the first thing is that I need to find out this. Okay, what is the probability of price going upwards and downwards? Okay. How will I calculate now the probability of price going upwards or downwards? So as we all have discussed, that current market price is nothing but 1 divided by 1 point discounting factor into. Can I say this is nothing but, see, this is 60 and this is 40, my dear students. Okay. So basically it will be nothing but, can I say 60, estimated price, that is 60, into probability of price going upwards, plus this will be 40 into probability of price coming downwards. So this is now going to be 1 divided by, what's my discounting factor? My discounting factor is nothing but the risk-free interest rate is 6%. So this is going to be 1 divided by 1.06, and this will be 60 into x plus 40 into 1 minus x. So in this particular case, it will now become 1 divided by 1.06, and this will be 60x plus 40 minus 40x. Okay. Now this will be 1 divided by 1.06. So this will be 20x plus 40. All right. So now eventually we have the current market price. What's the current market price of the stock, which is 50 rupees? So if I take 50 and multiply that by 1.06, so this will now be 53. So this is 53 is equal to 20x plus 40. So this will now be 13 is equal to 20x. So your x will now be 13 divided by 20, and that will be 0.65. So the probability of price coming upwards is 65%, and the probability of price coming downwards is 35%. I hope you guys are trying to understand this. The probability of price coming upwards is 65%, and the probability of price coming downwards is 35%. Okay. Are you all okay with this much part first? So we have got your PU and PD. Okay. So I now know that this is 65%, this is 35%. This is 65%, this is 35%. This is 65%, this is 35%. So I've got the probability of price going upwards and downwards. Okay. Now I have told you that using the binomial risk, calculate the value of the call and the probability. So probabilities we have already calculated, and also draw two step. We have already drawn that, a decision tree, binomial tree, and what is going to be the payoff. So now, my dear students, let us calculate what should be the value of the call, okay, at this particular node. So now I will now name this as my node A. I will name this as my node B, and I will name this as my node C. Okay. First of all, my dear students, do I have the value of call option available at node B and node C? That is at the end of year 1. Then the answer is no. I have the value of the call available at the end of year 2. That is, for node B and node C, I have the value of the call available. But for node A, I don't have the future value available where I can discount it and bring it to the present. So in this particular situation, what you need to do? First, we need to calculate what is the value of call at node B. Okay. So I need to first find out what's the value of the call at node B. So this will be 1 divided by 1 point. What's my discounting factor? 0.6. Okay. This multiplied by. Now what is the value of the call which is possible? This is 22 or 0. So this is now going to be 22 into probability of price going upwards is 0.65 plus 0 into probability of price coming downwards, that is 0.35, because as you all can see, this is 0.35. Okay, so this is 22 and this is going to be 0. Okay. Now, my dear students, this will eventually be 22 into 0.65, and this will be divided by 1.06. So ultimately, this is going to be 13.49. Okay. So 13.49 is the value of the call at node B. What is the value of the call at node C? Let us talk about that. So value of call at node C will be 1 divided by 1.06. Okay. And this is now going to be, can I say this will be 0 and 0 both? Okay. So this is now going to be, can I put it like this? At node C, the value is 0 into 0.65 plus 0 into 0.35. So ultimately, this is now going to be finally 0, value of the call at node C as well. Okay. So my dear students, now do I have what should be node A value? Okay. Here there is node B, here there is node C. So node B, do I have the value of the call? Yes, sir, 13.49. For node C, do I have the value of the call? Yes, that is 0. So now can I calculate the value of the call at node A? Come on, yes or no? Yes, sir, I can do that. So did you realize in a two-step table, this is how we calculate the value of the call. So first we calculate the value of the call now at node A. How will we do that? So we will be now taking into consideration 1 divided by 1.06 and this is 13.49, which I need to multiply by 0.65 plus 0 into 0.35. So this will now give me 13.49 into 0.65, and this I'm going to divide by 1.06. So ultimately something like 8.27. This is now going to be my value of the call option at my node A. Okay. So you should be getting this as an answer. Value of the call at node A, which should be coming as your finally 8.27. Okay. I hope my dear students will have understood this much part. Okay. So based on this, my dear students, again these questions are also based on the same part. As I've taught you the arbitrage in the risk-less model, the same concept of arbitrage is going to come in these questions as well. So it will be very convenient for you to solve this particular part. Okay. So with this, my dear students, now I complete my risk-less as well as my risk-free model. Okay. Risk-less, risk-free and risk-neutral model. And now let me quickly do your put call parity. Okay. So what is the application of the put call parity and how do we calculate this? So see, first of all, uh, in the put call parity, this is actually called as a model in which we can find out the price of one of the option contract if the other option contract is available. So also known as something called as price discovery model. Okay. So basically, first, let's say for example, uh, I want to buy an equity share. Okay. I want to buy an equity share. Okay. But I want to buy an equity share, let's say, for example, at the end of year one. Okay. So what will I do? Let's say, for example, I will enter into an option contract where I will tell that, "Hey, listen, I have a right to buy this particular share for 100 rupees at the end of year one. Okay. So for that, definitely I have to pay a call premium. But I know that if I have to pay 100 rupees at the end of year one, I have to first arrange for that 100 rupees today. So what will I do in that particular situation? I'll calculate. I'll take the present value and I'll deposit that in risk-free security in such a way that it becomes 100 rupees at the end of year one. So let's say, for example, you want to buy shares of BIL for 100 rupees. Okay, you want to buy the shares of BIL for 100 rupees. Now, my dear students, when you want to buy the shares of BIL for 100 rupees, in this particular case, when you want to buy the shares of BIL for 100, the market price of BIL today is, let's say, 100 rupees, and you want to buy shares of BIL at 100 at the end of year one. So what is something what you're going to do? You will definitely buy a call option with a strike price of 100 rupees, saying that at the end of year one, I'll buy Reliance or I'll buy Bhavin Industries Limited for 100 rupees. Okay. So for that, you have to pay that premium. And you know that at the end of year one, you have to pay 100 rupees to buy that particular shares. So you will definitely invest its present value today. So how will you invest the present value today? You will take 1 divide by 1 point, whatever is the discounting factor, multiplied by 100, you will deposit that in the fixed deposit. Suppose the fixed deposit rate is 7%. So what will you do? 1 divide by 1.07, your PV factor is 0.9345, multiply that by 100. So 93.46 is something which you will invest today. 93.46 you will invest today at the end of year one. Can I say it will become 100 rupees? Come on, yes or no? Then the answer is yes. So this 93.46, it will now become 100 rupees at the end of year one. So your portfolio will consist of present value of strike price plus whatever is the call premium. Okay. This particular portfolio be sufficient for you to buy an asset at the end of year one? Come on, yes or no? Yes, you can definitely buy it. Okay. So this portfolio is called as fiduciary call. Okay. And also at the same time, let's say for example, you want to sell a particular stock. Now you want to sell a particular stock. Okay. But you want to sell it after the period of 1 year. You are afraid that what if the market prices are going to fall? So what do? You will definitely buy a put option in that particular case. So then this particular portfolio is actually called as your protective put. So what is a fiduciary call and protective put? Your protective put portfolio is nothing but very commonly used by layman investors also, that when they have investment in a particular portfolio and when they fear that the market prices are going to fall, what do? They buy a put option. So protective put means they are going to buy a put option. Okay, so they'll be buying a put option, and also correspondingly, the second part is your fiduciary call. So they will be now, entering into a contract where there is going to be fiduciary call. So fiduciary call apparently means what? That there will be a portfolio in which we will be, purchasing that portfolio, where we'll be buying a call option and there will be present value of the strike price. So together, my dear students, there's protective put and fiduciary call. So if the value of the portfolio is same today, the value of the portfolio has to be same at the end of year one. This is the logic of put call parity theorem. So based on this, now let us calculate what should be the call and put option prices. So if I know the value of the call option, I can definitely discover what can be the value of the put option. So, or vice versa. So this model is actually used under what situation? That when you have one call option available, what should be the put option? Okay, for that other particular stock. Okay, for that stock at this particular exercise price, what should be the put option? So that is something which we discover it by this particular model. So this model is used under situations when you don't know what should be a call premium and a put premium. So for that, we use this put call parity theorem. Okay. So let us do one question, directly, which will help you to understand this entire put call parity theorem. And this will make you, you know, understand this in much better way. So your question number 26. Okay. Now, do you have the spot available, the current share price available? Yes, sir. That is nothing but 90. Option strike price. So strike price is 110. Risk-free interest is 10% and time period is 1 year. Call premium is 20 and your put premium is 21. You are required to analyze if there is any arbitrage opportunity of none. So if these prices are correct, obviously can I say that protective put should be equal to fiduciary call, right? Because both of them are having the same strike price of 110. So if these prices are correct, your protective put and your fiduciary call, both these portfolios have to be the same. Guys, if it is not the same, can I say that there is a scope of arbitrage profits? Come on, yes or no? Then the answer is yes. So, okay. So what are we going to do here is at day zero, okay, let us create your portfolio one. Okay, this should be equal to your portfolio two. Okay. So my dear students, what's your portfolio one? It is, let's say, protective put. Okay. So what is your protective put? It is nothing but stock plus put option, and this should be equal to fiduciary call. Okay. So what is my fiduciary call, my dear students? It is nothing but whatever is my call option plus present value of strike price. Okay. Now, what is the spot price today? The spot price today is nothing but 90 rupees. Okay. So your current share price is 90. Now, what is it given to you? Yeah. So let's say, for example, your current market price is 90 rupees. Okay. So I'll take now 90. What is the put option? The put option which you have is nothing but 21 rupees. What is something which is given to you as 21? And what is the call option? Call option is 20 rupees. Okay. And this should be equal to present value of strike price. So what's your strike price? Your strike price is 110. So what we need to do is 110 into 1 divided by 1.1. Okay. So eventually this will be 90 plus 21. So that will be 111. And ideally this should be equal to 1 divided by 1.1 into 110. And we can add 20 to it. So this will now become, how much is this going to be? 1 divided by 1.1. So this is 0.909. Multiply that by 110. To this, I will be now adding 20 rupees. 20, or what is it? Call premium. Okay, do one thing. Make this as, let's say, for example, 12 rupees. Okay, so the call premium is 12 rupees. Example. So now, because that will give me much more accurately, it will help me to determine this is 112. So let me put it like this, that both the things are not equal. Okay. So when both the things are not equal, your call and your put, your basically your fiduciary call and your protective put, both of them portfolios are not equal. So is there any arbitrage gain which exists? Yes, arbitrage gain will exist and there will be rupee 1 arbitrage gain. So what are we going to do? We will be buying this and then we will be selling this. Okay. So undervalued portfolio will definitely buy it and we are going to sell this. So let us see what is going to happen. See, when you buy this entire portfolio at day zero, can I say there will be stock payment which will be done? Okay, so there will be buy stock. So how much stock price are we paying? 90 rupees. So 90 will go. Second point is we will be buying the put option. Okay, so we are buying the put option as well. So this will also lead to the premium outflow. So what's your premium outflow? That is 21. Okay. Then my dear students, we are selling the call. So that will be premium received, sell call. So that will be the premium received, that is 12 rupees. So I've just modified that to 12 rupees. And uh, what is this? See, ultimately, this was nothing but the amount which was supposed to be invested, right? But now, my dear students, we are not going to invest this particular part. So can I say that the present value of this of 110, instead of investing, will be giving that by the way of your loan. Okay. So this will be your loan. So loan, matlab we have to take the loan for the purpose of buying the stock. So ultimately we were, if this would have been bought, right? If this particular portfolio, fiduciary call, if this would have been bought, it means that I would have invested in the present value of the strike price. But because I'm selling this, so it means what? Instead of investing, I'll be receiving the money. So receiving the money actually means what? Loans taken, and that will be 100 rupees. Okay, so that is present value of 1110 into 1 divided by 1.1. So this will be 100 rupees. So can I say this is inflow? This is actually required to buy the particular stock. This is also inflow. And these are the two outflows. So ultimately, what is going to be my day zero inflow outflow? Let us check that out. So that is going to be 90 negative, 21 negative, plus this is going to be 12, plus this is going to be 100. So ultimately there is 1. So 1 rupee you are going to receive, okay, today itself. Now when you are going to receive 1 rupee today itself, whatever is going to be at day 365, okay, at day 365, my dear students, your strike price can be anything. Your strike, the price on expiry, let us keep it anything. Suppose the price on expiry which I'm keeping is example 150. So on expiry, if I'm keeping the price as 150, okay, or if on expiry I keep the price as 50 rupees. So what will happen? The first thing is I will be selling stock. So will I be receiving 150? Yes, sir. Second, I will be selling put. Now, my dear students, what will happen to the put? I have a right to sell it at, okay, I have purchased the right to sell it at, what is the strike price? 110. Okay. The strike price is 110, my dear students. And now the spot on expiry is 150. Will I exercise this right? Then the answer is no. So value of the put is going to be zero only, my dear students, because this will automatically become out of the money. Okay. Why it will become out of the money? Because we are the option buyer. We have bought the right to sell. So when we have bought the right to sell, my dear students, this is going to be out of the money. Okay. In the third situation, what is happening? We have sold call. So let us now see what is the value of the call. Okay. So now, my dear students, yes, now the value of the call. Can I put it like this? That the value of the call will be now negative, which is going to be loss for me. Why? Because I'm an option writer. And for an option writer, when it becomes in the money, for an option writer, when it becomes in the money, automatically you all know what is the final conclusion of the same. If it becomes in the money, my dear students, can I put it like this? That the value of the call is going to be the loss for the option writer. So we are the option seller here. So this 40 rupees is going to be the loss. And ultimately, whatever loans we have taken, we have to repay that loans. So at what price are we going to repay the loan? So we have taken the loan at 100. We'll repay this at 110. Eventually, you will come to know this is going to be 150 minus 40 is 110 minus 110. This is 0. Okay. So ultimately, can I say you had got an inflow of 1 rupee at your day 0, and at your day 365, you all can see that your first portfolio and the second portfolio inflows and outflows are met internally. So ultimately, there is an arbitrage gain of 1 rupee. Okay. And also at the same time, when the strike price is 50 rupees, can I say we'll be having a portfolio in which the stock value is 50 rupees? Now this put option, this strike price of 110 will become in the money because I have a right to sell it at 110 and it becomes 50. So it becomes in the money. So this will be 60. Value of the call. Okay. Now this becomes OTM and I am the option writer. It's good for me because I'm the option writer. This will become 0. And now the loans which will be repaid, that is now going to be 110. So ultimately, my dear students, this is also going to be 0. So in both the cases, this will be 0. So my arbitrage gain will be 1 rupee, which I've earned at my day 0. And of course, because I've earned at my day 0 1 rupee, I will also earn interest at the rate of 10% on it. So this will now become 1.1. So this is how, my dear students, we calculate your arbitrage gain in your put call parity. So in put call parity, what you have to understand is that the two portfolios, my dear students, will always have the same value. Okay. So only then we can say that for a same strike price, the call and the put premium both are correctly priced, or else there is an arbitrage gain opportunity. Okay. So we have protective put and fiduciary call. So someone who has stock has the fear that what if after the end of year 1 the stock prices will fall, so it will purchase a put option. So stock plus put, that is one portfolio, that is called as protective put. And second, someone who has purchased the shares or who wants to purchase the shares at the end of year 1, he has a fear what if the market prices increases, so he will buy a call. So and he will invest the present value of the strike price. So that is fiduciary call. So protective put and fiduciary call both should be equal. So for that, we will have stock plus put is equal to call plus present value of X. So we have stock price of 90, we have put which is 21, we have call of 12, and then the present value of X. So we have the value of both the portfolios, that is 111 and 112. So we will see that, arbitrage gain here is nothing but 1 rupee. Okay. This is buy and this is sell. So we have day 0, and at day 0, when we are buying this protective put, we are buying the stock for 90. We are buying the put for 21. We are selling the call, so the premium is being received. And we are, instead of investing, we'll be getting the loans because we want to buy the stock. So that is at 100. So basically, we'll be getting the final inflow of 1. Whatever is the price at expiry, don't worry. Your both the portfolio values, inflow outflows, will be internally adjusted. So we will be definitely getting only arbitrage gain of 1 rupee at your day 0. You add the interest element to it because we have this 1 rupee for the entire 1 year. So this will now give me 1.1, and that is your final answer. So my dear students, I've explained you put call parity theory also. There are two questions of it. You can very easily do it. Okay. Now see, for some of the strategies, my dear students, I would recommend that, ICAI basically have, removed some part of it like butterfly strategy, etc. All these things from the study module as well. So there is just spreads which are there, and some of the spreads which are there, we can do it later on when we'll be doing forex at that particular point of time. Also, we can do it. So for the options part, till now you can just do it this much and revise it very, very, very thoroughly. Solve these questions. I've explained you each and every concept. What is, how do you consider the pricing of the options? Then I have taught you what will be the value of the option, what is going to be the intrinsic value as well as the time value. Then what is the moneyness of the options? How do you calculate the payoffs? We have done that as well. Risk neutral model, riskless model, put call parity theorem, and also we have understood the other parts about arbitrage gains, loss, etc. Everything. Okay. So I hope, my dear students, you all have understood what we have done today. Now, in the third part of the derivatives revision, which we are going to do tomorrow, there will be Black-Scholes model and the other parts which will be doing that tomorrow. for your put call parity, for your other part real options as well. So that will be introduced to you tomorrow. So that's it, my dear students, from my end. I hope you all have enjoyed the options part. So your futures are done, your options are done. Now tomorrow we'll be doing real options, black shoals, etc. We'll be doing that tomorrow. So I hope you all have enjoyed this. So that's it, my dear students. Bye, guys. Take care. See you. Take care. Bye.